Hi, good morning. Just a very quick and brief overlook at what is happening. And we shall start with the MOVE index because what I find interesting is that while the market over the past couple of weeks has really done nothing in terms of bond pricing, the MOVE index keeps on going down. And I am watching like a hawk these levels between 97 and 89 because this is where the as you can see in 22 we started going up, and I'm looking at the signal to break back down for a rally in bonds. I don't think it's imminent, but that is what I'm looking at. And what I find interesting is that throughout the past 2 weeks, let's say, while the market's been doing nothing, the MOVE index has been coming off. That tells me that bonds are comfortable in the ranges that they're in, and really that we have discounted the higher supply, and that we are now really looking at real data to tell us what the shape of the yield curve should be and what the absolute level of rates should be. Hardly any point in going through all the individual tenures because twos are completely stuck. I would be very, very surprised if over the course of the next week, when we have very little data really, we just have the issuance on Monday and Tuesday, and it's pretty heavy. But this 499.5, call it 5% level, is in twos. I really don't think that we can move very far away from it, even before the issuance, but certainly after the issuance. I really don't see what the point would be. The market knows that the Fed is done. Okay, unless real data comes out from now on that shows that the Fed needs to move again because rates are reaccelerating, this 5%, when I say rates, I mean inflation rates are reaccelerating. This 5% level is an excellent level to get in on the long side of prices and the short side of rates. I think that we are now stuck between this 475 and 5. I really think that any move up here is going to get bought heavily. So I really am not worried about being long twos anywhere above. Anything with a 5 big figure, I think twos are a long. Fives and tens and 30s, much the same thing. Anything around here with this 455, I think you get long because the market is not going to give up on the Fed cutting rates sometime in 2024. It's just going to price in and price out how much of a cut and when it happens. So I think the odds of us going back up here are very, very slight. So you have a 15 basis point risk by getting long somewhere in here. That's about as much as I can see. And in tens, I think the same thing. Anything around 458, 460, I think the pressure is all going to be on the downside. And if you look at the yield curve, let's say twos, tens, you know, how how much more can we flatten? Well, we can flatten to about here. That's another 14, 15 basis points, and that more or less matches what I've been telling you. The pressure, if there is pressure, is going to be on the twos. I don't think there's going to be any pressure. But that's about all the yield curve can do on the upside, and then you're looking for steepening again. I just don't think these markets can move very much with the information that is going to be coming in the next week, and I don't think there's any point in forcing them. I think buying at good levels to be long is going to be a better strategy than selling at prices. The market tone has changed. That MOVE index moved back down to the lows or towards the lows, and let's have a look at it again. indicates to me that the market is very comfortable at these levels and something new needs to come out in terms of real data before any substantial move can happen. From now on, we're literally trading for ticks. We're trading for a quarter of a point and in and out. I have not changed my mind about Germany. I think that what happened last week was, ridiculous, and the way they presented it was ridiculous, i.e. they mishandled it very badly in terms of what they wanted to communicate about the budget and the way they're going to issue. But I don't think it's going to make any lasting difference. I think the bubble is the clearest, and we could easily be in a period like this sideways. But to me, anything around this level, i.e. 265, 266, which corresponds with that level around the 116.15 area, just above 116 in futures in the Z4, and then calculate your own basis out to H4 if you Z3, and calculate your own basis out to H4 if you want to get into H4. But this area to me is a much better buy than sell in terms of futures. I think that Europe is on a track south in rates. I think they will be the first to cut, and if they're not the first to cut, then they will be the ones that cut deepest. I think these levels are a great buy in terms of call spreads, and I just can't get short of them. It's just a question of where you buy them, because to me, at some stage, we break this level, this 245, and we get everyone long. Now, whether that is going to be wrong or not is neither here nor there. But I think from here, the path of least resistance over time is going to be to start breaking down and going down towards these levels. I think it's as simple as that. I wouldn't trade the Shats. I don't think the Shats can really do it. I think Bunds are probably a better buy than Bobble, but Bobble is so much clearer. I think if I see the Bund right here at 270, Monday or Tuesday or Wednesday, I think it's an excellent risk-reward buy, and I will definitely tweet it. If we have a look at the butterfly with the with Italy, so Germany in the middle, Italy and the US on the wings, it's, I think it's done as much retracement as it can. I don't think this threat of greater issuance in Germany is really going to pan out or be very significant. I think this has been the move that takes it into account, and then from now on we're looking to come back down. So the low issuer, i.e. Germany, even if it might not be as low as we thought it might, I think is still going to be favored over time, because the quantities are so little compared to what the others are doing. And to me, this kind of level, if we see it, and that would probably correspond with the Bund being at that 70 level that I just indicated to you, I think the risk reward is all again to the downside. So I have not changed my mind about Bunds. I still think that all these bond markets are going to do better over time. It's just that you have to be very, very precise and surgical where you get in from now on, because the moves themselves are going to be much smaller until real data says, yes, the timing for the central banks is now. And I don't think that is imminent. I think it's going to take months for that to come out, because the uncertainty of what the economy is doing is still far too high. I think the uncertainty in Europe is a lot lower than in the US, but I don't think that Europe can go without the US. The spread can move 10, 15 basis points, but that's about it. And as far as the spread between Germany and the US, if the market thought that the news that we got out of Germany about the issuance break was significant, I don't think this would have been the price action. Uh, a few billion here or there is not going to make much difference. To me, we are probably in a period like this, doing not a lot. So I still see this 172 as very, very significant. And as long as we maintain being above it, I think the risk reward is to buy it off that level, which still indicates to me that even if the differential between the US and bonds is not going to be that great, that bonds are still the better risk reward in terms of placement of the trade and subsequent returns. So that's why I just can't get bearish of Germany. If I'm not bearish of the US, I just can't get bearish of Germany. I don't think the spread moves very far. I think the butterfly with the high issuers and the low issuer has gone nearly as far as it can go. So to me, the risk reward of being long in bonds is still in Germany at levels, and you have to be very precise. And the bubble is the clearest technically, isn't it? And the bond is the one that's probably going to give you the best risk reward. But you have to be very precise from now on. This is going to be a market for ticks. A quick look at the VIX. I mean, it reminds you very much of that move index, and I think the VIX can come down because the move index allows it to come down. Now, is the VIX going to move a million miles from here? No. I mean, I really wouldn't bother selling it. That is stupid. But what it does tell you is that retracements in equities are going to be very, very shallow. Why they're going to be shallow? Well, because retracements in bonds are going to be shallow. And I think that that is the narrative here. Until the move index starts moving up, and I don't think it will. And, you know, the equities are going to be stuck in this uptrend with very shallow retracements. And here you have SPY TLT, and really in 2 weeks it's done nothing. But it just shows you that the relationship is very much one of positive correlation. And if you have a look at ITOT over government, so that is the totality of everything, right? The totality of bonds and the totality of the stock market. So you're talking about all the shares. You know, what can I say? It's going up. And while this trend is there, it just indicates that if bonds are going to do very little, that means that this move down should it happen in equities is going to be limited as well, right? So it's limited to a couple of percentage points in equities. Say the bonds do nothing. You know, how much is a move from 450 down to 440 going to be? It's going to be, you know, a couple of percentage points. So you know that what you are risking wherever you get into SPX is a couple of percent. So you can work out your own leverage. That is basically what the charts are saying, that the correlation is still positive, it's still strong, and you're going to have very low dips. And that is what the MOVE index is saying, that is what the VIX index is saying, and that is what the spread indicators and risk indicators are telling you. Very little downside that one can perceive in equities at the moment. So let's debunk some myths. I mean, this is the Dow over the NASDAQ, DIA over NDQ. It's really done absolutely nothing since June. It's gone up and down, but net, nothing. So these are defensive stocks. I mean, the big cap. And it's just showing you that it's not the NASDAQ that's going up. more than anything else. This is a relatively stable thing. So it's all these big cap stocks, and this is RTY over the Dow Jones. So this is the small caps. Now I think the small caps are turning. I think that we've gone down to levels that we were during COVID, right? And we are now beginning to bounce again. I don't think that this relationship is going to remain at these levels. I think it's more likely to go up by 5–10%. And let's have a look if I can change this to, I don't know, a monthly chart. You can see how low we are. We are at levels that, we haven't seen for a very, very long time. I think the small caps, if you don't have any, it's probably worthwhile having some at these levels compared to the big caps. So what I have done is I've shifted some of my exposure to US equities into small caps, simply because they give me optionality. I mean, how much can I lose from these levels? I mean, 100%, of course, theoretically. But I don't think that index is going to zero. And it gives me optionality should good news strike. And it's almost a hedge against bonds. What would be the good news? That the economy is stronger than the small caps have priced it in. And therefore bonds don't perform very well, but then this should really perform. But you get the idea. I think that at these levels it very much pays to have some small caps on board. And if it pays to have some small caps on board in terms of risk reward, that also confirms to me that the downside in equities overall is very, very small. So let's have a look at my clean chart. And try to see where, a potential target to the upside here is, because I think the downside, if you see this level of 44.80, I think that's about, they might give it a little bit of a panic to someone, but I just don't see why they would. To me, this kind of 4700, 4712 is the level that the move should be exhausted at. Why? Because if I look at this indicator here, I think we're not overbought enough to have a reversal. And normally what tends to happen, if you go back to the VIX chart, is that you tend to have 2-3 weeks of very low VIX prices, which are basically stable in that 12–13% area, while the market here wedges higher and gets people longer and longer and longer, and it gets to a stupid level, and then everything is ready to come down. In the meantime, this indicator goes back to this level and gets overbought. So you can see how it works. Look at this period here, okay? We are more or less here, and it takes time. It takes, 3 weeks to get up there, and then, poof, then it can come down. So I don't think that we are in a position to come down here. I think we need higher prices eventually. So I'm a buyer of dips and a seller of puts still. And I will buy dips if there are some next week. I think there's a decent chance of them, have coming at some stage, because I don't think the bonds are going to go straight up. I think there are going to be some scares in bonds to the levels that are indicated, and I intend to buy them. And if that scares equities, I intend to buy those as well. Lastly, a quick update on oil, because I think there might be a trade there next week. I think I would love to see a break of this 72.36 to the downside. And I think then people would really panic and dump everything they have. And I think that that will be the opportunity to put on some call spreads. We will see that next week. If it happens, it happens. And if it doesn't, I don't care. But I think that if you get this break, people will really start panicking. And it will be the opportunity to buy some 2 3 month call spreads around 70 85, something like that, because volatility is coming down there as well. So this kind of level, what is that, 70 30, just below 70ish. If you see it down there, I think a call spread is called for. I don't think the market is just ready to collapse. I really don't see why it would. Supply and demand are perfectly in balance. If it starts going through there, then it's really telling you something about the economy, I would have thought. And I can't see that the timing is now, because otherwise bonds would be telling us, and bonds are actually telling us, that it's going to be a while before any signal emerges. And that's all I have for you. Very quick update. Thank you very much, and tweet you tomorrow.